and China Evergrande is one factor among many factors that could delay the projected recovery that we see in Q4.
Hi, it's Genuity, Vice President, Senior Investment Advisor at Canaccord Genuity Wealth Management and ggoernert Wealth Management. And welcome to the channel where we help you make sense of the financial world. Today on the show, we've got Canaccord Genuity, North American Equity Analyst, Martin Roberge. Martin, how are you?
I'm good, and thank you for having me on your show.
Always love having you on the show. Now, China crisis, we've got China Evergrande. A lot of people are asking, is this the end of the bull market? What are your thoughts there?
Yeah, no. As far as the market is concerned, we're going to talk into more details in a few minutes about the foundations. We're seeing some cracks here and there, but again, like we're probably good for another cyclical advance in this bull market. Timing is obviously everything. Like, is the next leg starting in a month from now, starting right now, in 2 months? We'll see. But there's certainly more upside, especially when it comes to some areas of the market that have lagged, cyclicals in general. So right now, the market is kind of in no man's land. On one side of the market, growth stocks are being impaired by lofty valuations and the increase in bond yields. Growth stocks are long duration stocks. They're very sensitive to any significant move in yields. Yields have been rising, so they are kind of in the sin box, if we can put it that way, owing to rising bond yields. And the value stocks, the other side of the market, more cyclical in nature, they have been dealing with this global growth slowdown over the summer, and China Evergrande is one factor among many factors that could delay the projected recovery that we see in Q4. But we do see a recovery in Q4. Again, it's just a question of when. We believe it's going to be more back and loaded, and by the time we get to the second half of the fourth quarter, we think that the Chinese authorities will have sorted out the saga with Evergrande, and again, people wondering if this is going to be the next Lehman Brothers. No, this is not a bank. Okay, this is a property developer. You just want to make sure that the company delivers on the properties that they have promised to buyers. So in order to avoid any contagion spilling over into other areas of the market in China or other areas of the economy, the central bank in China has a lot of ammunitions to deal with this issue. Don't forget, the Chinese central bank, they have very little bonds on their balance sheet. So if they needed to do like the Fed, the DOJ, and they could start quantitative easing in a heartbeat and provide as much liquidity as is needed to stabilize the condition. So no, it's just that it's going to be a gradual process. Probably there will be some debt rollovers, credit extensions. The company will need to sell some of their properties to get some cash. But at the end of the day, we don't think that this is going to derail the Chinese economy or the global economy, especially considering that, like in Canada, the net worth of Chinese individuals is about 30-40% of their total net worth. So no way that the Chinese authorities will let Evergrande go bust.
Okay, well, now that's a good point. Now the other thing that we've seen here, and I touched on it earlier, we've had these smaller corrections throughout 2021. We haven't, I think we're all kind of expecting somewhat of a bigger pullback that we just really haven't seen. So every time we see, the market sell off quite a bit, it looks like it's kind of starting, but something always comes in to kind of push things forward again. How are you seeing the market set up for the fall? I mean, you mentioned that things have been delayed until Q4. We're in fall as of 2 days ago here. How are you seeing things play out as we get into October into December?
Yeah, usually the calendar, like we all know about the negative seasonality in September and October, so
Yeah.
we're aware of that. We've been aware also that the Fed would be announcing probably a tapering of its bond purchase programs. That came out yesterday, so
Yeah.
they're going to start and do it. So over the last, so far this year, there have been 5 pullbacks, including this one of about 3-4%. And every single pullback so far this year ended when about 30% of stocks were below their 50-day moving average. This one at Monday's close was also showing a 30% reading. So conditions were similar to where we were earlier this year in terms of oversold conditions, and we got a snap back. My only concern is that compared or contrary to those 4 other pullbacks, technically, the technicals of the market are a bit weaker. Breadth is way weaker than it was earlier this year. Inflation is a lot higher than it was earlier this year. Growth is not accelerating like in the first half of the year. Growth is decelerating. And most importantly, if you look at the amount of leverage in the equity market, it's still very high. It has doubled since January. Pretty much everybody's long the market. And so my hunch has always been that there would be 2 possible scenarios for the fall: a price correction or a time correction. The price correction was very short, but it could well be that we go down again in October, or we deal with a time correction. Time correction
Right.
meaning that the market continues to churn. But one thing is for sure is that by the end of the year, whatever we lose from the recent peak, history shows that we make it up,
Right.
and some more over the first quarter of the following year. So I don't want to be too cute, because I don't think this correction will be like the big correction that everybody is expecting. I think this is probably more a 2022 story. And as a hedge, just in case I'm wrong about this timing this correction, I think one bullet strategy is just to go into the value names,
Right.
which have lagged, and we know that the leadership from the market going out of this correction will probably be driven by the value stocks and the cyclical stocks, because we're going to be in a rising rate environment. We went down to 110, 115, and now we're seeing probably an increase back to where we were in March, which is around 175.
Yeah, and that's a good point, because the world has been locked up, in particular in North America, or I guess around the world. There's a lot of pent up demand on the sideline. That was the last conversation that we had last time we talked. How is that being reflected into the marketplace now in valuations?
Well, it's actually the lack of or the supply bottlenecks, transportation bottlenecks, or supply chain issues. Obviously, those issues are headwinds, have fed a rally, has triggered a rally in the growth areas of the market, which are less sensitive to growth conditions. So you got one side of the market which has benefited handsomely from the lack of growth this summer and this fall. The growth momentum has been slowing, rewarding the growth areas of the market. This pocket of the market, in our view, is not only overbought but overvalued. The value pockets have lagged, and they've been hurt by the deceleration in growth momentum. Valuation there is not an issue. Like, still very, very cheap and oversold as at last Monday's. We can talk about small cap equities as well, which have been lagging quite a bit. So to the extent that China is likely to remain a hot issue for a little while, large cap global growth stocks will probably be the most at risk of um, a, um, a situation where China doesn't get any momentum before next year. Okay, um, to the extent that again large caps are hostage of what's going on in China, we think that the small cap, which are more domestic centric, are about to re-rate higher relative to large caps.
Mm-hmm.
And when small caps do better than large caps, cyclicals do better than growth, value does better than growth, and the TSX does better than the rest of the world. So I'm pretty optimistic that we're going to see a change in leadership in those just areas that I just mentioned. And to this extent, again, if I'm wrong about timing this correction, I would recommend clients to stay invested in those areas and increase um, their investments in those areas on any pullbacks, and we've seen some of those pullbacks already.
Yeah, let's take a look into the commodity complex. Talk a little bit about base metals, maybe copper, aluminum, and then we'll move over to the gold front. I know you and I have talked about gold for the past couple of years now. Let's talk about maybe contagion in China and where we're looking at with on copper prices.
Yeah, a lot have been said about like the route in iron ore. Iron ore is used in various products, steel, obviously, and China is very serious about reducing uh, their emissions, or like turning green at an
Mm-hmm.
accelerating rate. Like they are really pushing to reduce those the use of carbons, and and as a result, they decided to impose curbs on steel makers in China, and and steel is such in high demand globally uh, that you're facing this situation where there's a clear lack of supply. Okay, um, so steel, aluminum, copper, like heavy industrial commodities, but
Mm-hmm.
those are green commodities in a way.
Right.
Iron ore is kind of a um, black commodity, or a dirty commodity,
Mm-hmm.
if we can put it this way. So, to the extent that people have been concerned, our copper prices have been like churning because of the scare about the iron ore plunge spilling over into other metal markets. We just don't see it, and and as we've seen with energy producers this
Mm-hmm.
year, copper producers are extremely sensitive to their capex strategy because they are sick and tired of being tossed around by the variants, the pandemic, where demand is so sensitive. So, given the choice between increasing capex for profitability or
Mm-hmm.
holding on to their capex to protect also margins and profitability, we believe that they will continue to be extremely disciplined until like we get maybe like 60-70% of the global population being vaccinated, and the COVID-19 virus is no longer an issue. But until we get there, we've got another year, if not more. So capex discipline is, along with all the natural demand from China and emerging markets in general, should allow base metals in general to continue to thrive. And actually, if you look at the performance of commodities relative to stocks or bonds this year, this is the top performing asset class. And actually, in September, we're making new highs. So this is one thing we've been recommending clients to maybe reduce some of the equity exposure, but put it in commodities, giving you some exposure also to the global economy being still relatively healthy, even though we're slowing down. We're just at the mid-cycle point of the business cycle. We're not at the late cycle point. So we still like commodities as an asset class.
Yeah, well, why don't we talk in particular about gold? Gold trade for the past little bit hasn't been working. What are your thoughts on that side right now?
Yeah. Um, there's a battle out there between those that are playing or seeing gold as a reflation trade, meaning that when the economy is slowing down, the Fed is not going to hike rates, the Fed is not going to taper, and actually this is positive for gold. But as you know, we've seen the opposite. We've seen the economy doing relatively well this year, and as a result, we're seeing the Fed announcing a tapering and Fed members advancing the rate hike, the first rate hike in 2022 versus 2023 about last quarter. So expectations are shifting towards an earlier liftoff in Fed funds. So this has been one of the problems for gold. The offset is the inflation story.
Mm-hmm.
For inflation to be a risk, you need inflation to be high and growth to be strong. I would say growth momentum, not necessarily the level of growth, but the direction of growth. And the direction of growth has been going down for the first 3 quarters of the year. Finally, we're seeing some stability in many in economic data. Like, let's say in the US, for example, the past 2 weeks have been very, very good. Outside, it's been very slow because of China. But as we said earlier in the show, back half of Q4, we should see global growth momentum. So the direction of growth, growing or rising again. And when you get the inflation push and the growth push, both going in the same direction, this is when gold will thrive in an inflation regime. So if you buy the inflation regime, you need both growth, strong growth, and high inflation. We've been missing the strong growth backdrop, and we think we're going to get it in Q4. So I believe personally that we're kind of in a volatile bottoming process for gold, and Q4 should be probably a good quarter for this space.
Well, with the pent-up demand and everything that's been going on, you got to think that growth is going to be very, very strong coming out of this. I mean, when's the last time that consumers have come out of a technical recession, with their financials as strong as their savings rates as strong as they've been? I think that is going to work its way back into the market. I mean, we've had delays. I guess Delta variant has delayed it again, and there's always a that stop-start that you and I have been talking about for the past year now. Just on that one last thing, are you seeing any changes on inventories company-wise, where they're strengthening their inventory base? Because there has been some hesitation in the past, because why would you want to build inventories when you could get shut down again over the next 6 months? Have you seen anything change there?
Yeah, actually, we're seeing some rebuilding outside North America. As you know, North America has been rebuilding slowly, but outside North America, like in Japan and in Germany, in the first half of the year, we were seeing companies keep on drawing down their inventories. In Q3 so far, we've seen some stability, and they've been slowly rebuilding their inventories. But Greg, we're a long way before we get sales matching the level of inventories. We've got to talk about Q1, if not Q2 next year, because we're still dealing with transportation bottlenecks and supply chain issues also. So this should get a little bit better in Q4, probably back to neutral back to normal in Q1, and then we are going to be probably dealing with a normal supply-demand cycle in 2022. But until we get there, growth is going to be probably driven by this pent-up demand from businesses needing to rebuild or regarnish their manufacturing, retail, and wholesale inventories.
Yeah. Hey, well, why don't we leave it there? Thanks for joining. Please, come back again in 3 months. We'll talk things over again. Martin Roberge.
All right.
Thank you.
That's it. Bye-bye, Greg.
Bye. Don't forget to check out my webpage at www.ggoernert.com. There you'll find even more to help you make sense out of your financial world.